All right, Brian, we're talking about why Americans are bad at saving money. We've noted that our retirement accounts are leaky. We try to keep up with the Joneses. The cost of a lot of the things we consume have gotten more expensive. We don't practice deferred gratification. And here's one that drives us nuts, that if we could just tell every young person, if we could just really get them on page with this, we think it would change their life, is that we as Americans, we don't really understand exponential growth.
Yeah, this is one, I just talked about in the previous section. We're all about that instant gratification. Give it to me now. I don't want to think about, because it's just hard for me to conceptualize something that's good for me 10, 15, 20 years in the future. Man, if they could just hang out with us and the money guy show, let it drip on you, and the fact that we talk about deferred gratification, the benefit, and we talk about the mind works in a linear fashion, but I want you to think about compounding exponential. You will be a changed person.
Yeah, it's really easy to think about. We think on this linear path. We think, okay, if I have $500 that I invest at 20, okay, it'll be worth $1,000 by 30, and it'll be worth $1,500 by 35, and then it'll be worth $3,000, and it'll be worth so on and so on and so on. That's not the way that it actually works. What actually works is when we can understand exponential growth, we think about, okay, at 20, I put my $500 to work. Well, by 30, it's grown to $1,300. By 40, it's grown to $3,600. By 50, almost $10,000. By the time it gets to 60, if I've compounded at 10% annually, that $500 has grown to almost $27,000. We have to understand that exponential growth is powerful, and we can have compounding interest working for us on our side. It really can become the eighth wonder of the world.
I think there's been a lot of research out there. Is the more education we can share with people about exponential compounding growth, the more likely people are to stick with it. I think there's one research study out there that shows that people who have learned about exponential growth, there's a 70% better chance that they will actually focus on doing better in their retirement plans and other things. And that's why, look, we try to create a visual. Some of you out there, you're watching this and it's still not connecting. You're like, I need a visual. I need an element that's going to help me connect on this. We came up with the Wealth Multiplier, and we have two versions of this. We have Wealth Multiplier for young savers, and we have a Wealth Multiplier normal. The young savers takes you from 0 all the way up to age 35. The regular one takes you from age 20 all the way up to age 65. If you go to moneyguy.com/resources, it's going to show you what every dollar that comes in your possession has the potential to become. There's a reason I had this koozie. If you can just let your money grow upon itself, you'll think differently, not only about how you save and invest, but also how you spend, because you're going to think a lot differently about that $1,000 a month car payment. If you think about what could that mean for me in the future, go check out our Wealth Multiplier.
All right, Brian, so we're talking about how understanding compounding interest and how it works can be valuable, can be beneficial, but we also think there's another side of that coin, and you have to understand how to have boiling point patience. This is something you came up with, Brian. What is boiling point patience?
Well, I worry about people, because when I started studying the behavior of becoming wealthy, it's not hard at all to get somebody excited initially about it. I remember when I first graduated college, I got every one of my close friends to read some of these key books in my life, and they all funded their Roth IRAs in year one.
One time.
Year two, they didn't fund it. And I started realizing the stickiness of actually keeping the positive behavior is tough for young people, because it's true. The first 5 years you start saving and investing, you're going to be like, wait a minute, the majority of this money is my money. Where's all this compounding growth these guys are talking about? You get to year 10, you start seeing it. Year 20, this thing's rocking and rolling. Year 30. So we wanted to show an illustration that actually kind of talked about this and walked you through it, because I need this to be sticky. I need this to be a behavior that you set it and forget it, not for 5 years, not even for 10 years. This is something that's going to take decades, but I promise you, if you can hear me out on this boiling point, it's just like the water. Think about the water when you put it on a pot, and remember, a watch pot never boils, it seems, because that's the part. It's the patience that you're going to be doing, the behavior. You're going to be putting the heat to something that looks no different, whether it's 0 all the way up to 212 degrees Fahrenheit. It looks like nothing's going on, but then magically, as soon as you reach the boiling point, you all of a sudden see it starts to bubble up. It starts to work upon itself. That's exactly what I need you to do with your money. even though on the surface it might not look like you're doing it, you save, you invest, nothing is growing upon itself. I promise you, if you can give it enough time, it will work. Bo, show them in real world what we mean by this.
Yeah, compounding takes time, but when it takes hold, it's amazing. Think about someone who's investing $500 a month. That's what they're going to do. Well, after they've done that for 10 years, they will have invested $60,000. Well, they look at their total account value, $42,000 of growth will have taken place. So they put in $60,000 and they have $42,000 of growth. After 20 years though, they've put in $120,000, they have $260,000 of growth. After 30 years, they've put in $180,000, they've had $950,000 of growth. And if you can do this for 40 years, again, just saving $500 a month after 40 years, you will have put in $240,000, and yet the growth, the compounding interest, the money that your money has made is over $2.9 million, but you have to give it time to take hold. You have to have boiling point patience.
Here's what I think is interesting. You see in that first decade, 3/4 of the money is you. Mm-hmm. Whereas when you fast forward to 40 years in the future, now you're not even 10% of the money.
That's right.
It is like 90+% of the account value is actually the growth, meaning it's not your contribution. Your contribution years ago is the foundation, but this thing has exponentially grown upon itself. I'm just sad. I need people to get beyond the present bias, actually let the money work, let it be patient. Deferred gratification will pay in the long term.
But we get it. You guys are saying, okay, guys, this is a hypothetical. That's an assumed 10% rate of return. That's not how the market works. That's not how investing works. We understand that seeing is believing, so we would encourage you, go do some research. Go look it up. Go look at historical rates of return, and let us help you. Let us show you how real world this can be. If you would have taken $100,000 or you would have had $100,000 invested in the S&P 500, not in anything special, just the 500 largest companies in the United States. In 1990, if you would have invested that $100,000, by the time we got to 2023, by the time we worked through that 33-year period, that $100,000 will have turned into over $2.3 million. A real world example, it's an annualized rate of return of 10.2% per year.
This is, I don't know how to explain this. For a person my age, I look back to 18-year-old self, 22-year-old self, and when I first got this understanding of what personal finance is, compounding growth, and let my money work as hard as I do with my back, my hands, and my brain, I remember thinking, man, if only I had started, I wish I was a little bit older so I could have been investing in the 80s, because it sure does look like people who started investing in the 80s made a fortune.
That's when all the money was
because
made.
I was in I'm in the mid-90s when I graduated. I'm at the back end before we get to the dot-com bubble. And I remember thinking, man, this isn't for me. I don't know if I can do what happened in the 80s and then happened earlier in the 90s, but here I am 20 plus years in the future. And I'm now looking back and going, thank goodness I started where I started and put a few $100s to work and then consistently paid myself every month. Because now I look back and I go, holy cow, I'm at this point now when I do our net worth tool every year. When you go to learn.moneyguy.com, our net worth tool, it's kind of a race to see how much more did my net worth go up above and beyond what I made in taxable income. That means when you get to that point, it's something we look for in our net worth tool, you're at financial independence. Yep. You don't work because the man makes you work so you can pay bills. Now you work because of the joy. You own your time when this happens. And I just worry about, do people catch a clue that if they will just start the process, because this will be repeatable. If we look at this 20 years in the future, 30 years in the future, the same people who might be starting at ground zero right now are going to be able to look back just like I have 20 plus years in the future and go, man, I'm glad I did it. So don't let this moment pass you behind. There are so many people out there telling you the system's stacked against you. This won't be repeatable. Somehow, though, when you look at the research and you see how long financial markets have continued to expand and grow, this opportunity will repeat for you too. You just have to start with small incremental decisions today.